pick up to around 6.8% in a couple of years.
Okay, so Manoj, I'm just going to come back to the point with regards to the current account deficit, because if there is some amount of easing on the gold import curbs that we did entail or put in FY14, then do you think that current account deficit could then resurface as a problem, maybe not as much in FY15 but in FY16? And what would be the structural measures that you think India needs to adopt in order to structurally improve the current account deficit?
Okay, tough questions to answer in a short time. I'm going to give it my best shot. I think if you do allow that gold import story to come back right now or in the near term, you are creating a risk. There's no doubt about it. Why? Because as I mentioned earlier, gold is an inflation hedge. And until you've resolved this inflation problem, people will resort to looking for inflation hedges. So the introduction or the removal, rather, of that ban on gold in the near term, while inflation is still high, while inflation is still a risk, is a clear problem as far as the current account outlook is concerned. I'm hoping they will stay away from that and instead concentrate on measures that bring down inflation. Once that inflation is down into a comfortable level, in the RBI's comfort zone of 5 to 6%, I think we've got less of a problem. Banning any commodity for a long period of time always creates structural distortions. It always creates other ways of solving that problem. So I don't think this is a good long-term strategy. But once you've got inflation resolved, I think you're okay. The second thing to keep in mind is not all current account deficits are bad news. They're bad news if they're too large, and they're bad news if they're the wrong kind of current account. So that was the problem, I think, with India's current account, is that it was a consumption binge. And it wasn't a consumption binge of the time that the US saw, where we thought, well, this might be a structural shift in the way the US produces and consumes before the Great Crisis. It was simply a cyclical reaction to a decline in investment and a decline in growth that led to higher consumption through fiscal and monetary policy. That's not the kind of current account that anyone wants to finance. And certainly when you're at 5% of GDP, no one likes it. Now, if you're going to run a smaller current account, you're going to run it because investment has been revived, because the administration's reforms are slowly seeping through, then that's the current account that I don't think too many people will have a problem financing. As it is, the FDI story is also something that will help finance this deficit. But also keep in mind that countries like Australia, for example, in the last 140 years, has run a current account for over 91% of the time. Of course, it's had its own share of problems with its currency, but the simple fact of the matter is, if you're an emerging market economy, you don't need to run a current account surplus. You should be running a current account deficit. It just needs to be the right kind and the right size of the current account deficit.
Manoj, over the last few weeks, what's been interesting is the kind of FI inflows into Indian debt market. Even though there have been some inflows in equities as well, but clearly debt inflows stand out. What's making the Indian debt market so attractive?
It's not just the Indian debt market. If you look, the story starts from the US side. If you look at what's happening in the US, except for the last few sessions, since the beginning of the year, we've had a growth scare over there. After that, the Fed, regardless of whether it was dovish or not, has been interpreted to be dovish. And that has pushed bond yields low. And if you look at vol, the implied volatility in the bonds and FX and equity space, that is at incredibly low levels. Now, the environment that you're creating is that there's a huge stable equilibrium in the US bond market. US interest rates are extremely low, and that's a massive green signal for a carry trade. So it's not just the Indian fixed income market that has received these flows. Brazil, Turkey, South Africa, some of the countries that had been under pressure at the beginning of the year, and like India, provide pretty high interest rates as part of a carry trade, have all done extremely well. What I think is different about India is part of that expectation about India is that the interest rate story and the growth story will continue to provide a rate of return without a currency fluctuation that will be severe. I do feel that for Brazil, for Turkey, for South Africa, when US real rates rise again and the US dollar strengthens, you will see much more volatility in those countries compared to India. Why? Simple answer is, as you've been asking, India's current account deficit is now under control, and the other measures don't look as excessive. I will point one thing out, though, is when you've received so many capital inflows in a short period of time, there is a risk, unconditionally, regardless of what has happened to your economy, there is a risk that small events or disappointments do lead to outflows that can create a bit of turmoil within the economy. It shouldn't last, but we should be on the lookout for those.
What would those disappointments be, or rather from an economic perspective, what would you be looking out for in terms of the next triggers for the Indian economy in particular?
I mean, let's be clear about this. I don't think this is a story of disappointment in India at all. This is a story of structural improvement. We've got people who are right for the job. But in the near term, the script has already been written in many other countries. You've seen Mexico. You were speaking in your introduction before we started our conversation about the Abe administration. That was an absolutely gigantic story about a year ago, and no one questioned the Abe administration. But as it's inevitable, these things cannot happen in a linear and a very, very simple fashion. If you talk to investors at an individual level, investors are very, very clear that, look, these reforms take time. They will take 6 months. They will take 9 months. You'll see a slow glacial process. And then after some time, you'll start seeing the full picture very clearly. But the market as a whole is not as patient. What we've seen in Mexico, what we've seen in Japan is that whenever these reforms have taken a little bit more time or the action on the ground hasn't been a steady, consistent one, people tend to take that as a sign that the model isn't working. Of course, they become re-engaged as soon as the process starts again. But in that near time, when the growth reports or the inflation reports sometimes come off a little bit worse than most people expect, and the progress isn't full tilt all the time, which it cannot be, it does lead to near-term investments. From my disappointments, from my point of view, I think those are chances where you come in and you get reinvested in India.
Okay. Manoj, I just wanted to focus on something which was a little more near term. What is your expectation from the European Central Bank tomorrow? And if in case they do come out with some sort of quantitative easing, what would be the impact that we could see in emerging markets?
So I'll try and give you a flavor of what we're thinking. We do think that action is imminent from the European Central Bank. They have a deflation problem at home, which is a homegrown problem. Some of it is good, some of it is bad. The good deflation is helping unit labor costs in the periphery. It's allowing them to become more competitive, have a better export story. But in the broader sense of things, it's not clear that good deflation always remains good deflation. As inflation expectations become mired in negative territory, that means that real interest rates are actually above nominal interest rates. And that's what the ECB is trying to get rid of. So it does need to act. We do think it will act. We do think there will be a rate cut which will take the deposit rate into negative territory. It need not be a massive one. The chances of outright quantitative easing, we think, are low. We don't think that this is something that the European Central Bank is going to embark on. But to answer your question, in case it did embark on QE, clearly the questions would be, well, what's the size of this program? What asset classes is going to adjust? And the impact on emerging markets, I think, if you take it in isolation, is of course positive, but it tends to help those economies which fund themselves in euro, the Central and Eastern European economies, or the ones that have links to European financial markets. But at the same time, I think it's very difficult to look at the European Central Bank in isolation, because as the European Central Bank embarks on a QE story, we do need to keep an eye on what the Fed is doing. If growth improves over there and the Fed remains dovish, but markets start pricing in the chances of an earlier rate hike, then you've got a bit of a balancing story going on, because US bond yields will rise as they have in this last week. That will put upward pressure on bonds, and the ECB will be trying to put downward pressure on bonds. So when you think of a balance between the US and European monetary policy and growth stories, then it's not clear what the European Central Bank action might be. Now, if the US is very quiet, nothing happens there, and the ECB embarks on a large round of QE, I think we would be fully cognizant of that story, and we would be expecting a much improved market scope even for emerging markets.
Okay, Manoj, we can go on and on about this, but we've completely run out of time. But thank you very much for taking the time out and talking to us. So that's Manoj Pradhan of Morgan Stanley, looks at emerging markets very closely. Remember that you can catch that conversation from the sidelines of the Morgan Stanley conference through the day.